Yesterday, I told you JP Morgan had a plan to survive today. I told you they would raid the SLV vault. I told you they would use every trick in the book. I told you to watch what happens on first notice day. What I didn't expect was that they would do something so brazen, so blatant, so desperate, that it would prove every single thing I said in less than 24 hours. Let me tell you exactly what happened. Because this isn't speculation. This isn't theory. This is data. CME's own data. Bloomberg confirmed it. And when you see the timeline, you'll understand why this might be the most important video I've ever made. Wednesday, February 25th, 2 days before today, first notice day. Silver had been recovering from its brutal February correction. After crashing from $121 all the way down to the 70s in early February, it had been steadily climbing back. And by Wednesday morning, silver was testing $91 per ounce. That's a critical level. $91 is the upper boundary of February's consolidation range. A clean break above 91 opens the path back toward $100 and beyond. Every technical trader in the world was watching that level. And then, at 12:11, Central Time CME Group, the company that operates COMEX, the world's largest metals exchange, shut everything down. All metals futures, all metals options, gold, silver, copper, platinum, everything on the Globex platform, dark, frozen, dead. The official explanation, quote, technical issues, end quote. That's it. No further detail, no elaboration, just a status page that read, investigating. Natural gas was quietly restarted about 40 minutes later, but metals, the category where the real pressure exists, where silver was breaking out, where March delivery demands were about to be filed, metals stayed dark. No timeline for resumption. All standard day orders were canceled. All good till date orders were wiped out. Traders who had been positioning for the most important delivery month in years suddenly found themselves staring at blank screens. Now, here's where it gets truly disturbing. CME said trading was halted. CME said the platform was down. CME said there were technical issues. But the volume data tells a different story. At 12:45 p.m., while the metals market was supposedly frozen, volume data shows a single bar. Of 31,828 contracts traded, at 5,000 ounces per contract, that's 159 million ounces of silver. That is not a rounding error. That is not a glitch. 159 million ounces is nearly twice the entire COMEX registered silver inventory, and it traded during a halt. Let me say that again so it sinks in. While retail traders and small funds were locked out of the market, while screens were dark. While CME told the world trading was suspended, someone moved 159 million ounces of silver. Who has the infrastructure to execute 31,000 contracts during a platform outage? Who has the connections, the access, the privileged systems to trade while everyone else is frozen? You already know the answer. And if you watched my video yesterday, you know exactly what that silver was used for. When trading finally resumed, silver didn't continue its breakout above $91. Of course it didn't. Because during the darkness, the game had already been played. Silver reopened and immediately got slammed $4 lower to 87. Then a second wave of selling hit at the London Open. Then a third wave was unleashed at the New York Open. By the end of Wednesday, silver was trading at $84.98, a $7 drop from where it was heading before the halt. But the price is not the real story. The real story is what happened to open interest. Before the halt, March silver open interest stood at approximately 21,882 contracts. That's about 109 million ounces of potential delivery demand. After the halt, after the mysterious 31,000 contract bar, after the 3 waves of selling, March open interest plunged 10,526 contracts. That's a drop of over 50% in one day. More than 11,000 contracts, representing 56 million ounces of silver, simply vanished from the delivery queue. Think about what that means. The entire battle we've been discussing, the 186 million ounces of March demand versus 89 million ounces of registered supply, that battle was supposed to be decided starting today, on first notice day. The whole world was watching to see how many contracts would stand for delivery, and someone solved that problem 2 days early, in the dark, during a halt. The remaining March open interest is now 10,526 contracts. That's 52.6 million ounces. Is that still more than what's comfortable for the exchange? Yes. Is it the extinction level event that 109 million ounces would have been? No. The CME successfully diffused the bomb, not by finding more silver, not by increasing deliverable supply, not by letting the market discover a price that balances supply and demand. They diffused it by shutting down the exchange, moving 159 million ounces during the darkness, crashing the price to $7 and using the combination of fear, margin pressure, and forced liquidation to cut open interest in half. This is the third time this has happened. The third time. November 28th, 2025, first notice day for the December silver contract. Silver was trading at 53.26. CME experienced a, quote, cooling system failure that halted trading for 10 hours. During the halt, it was reported that a Chinese industrialist had notified COMEX of his intent to take physical delivery of 30 million ounces. JP Morgan pulled 13 million ounces off the COMEX. The halt gave them time to reorganize. Silver subsequently doubled to $121 over the next 2 months, December 31st, 2025. CME raised margin requirements to $25,000 per contract over the New Year holiday. Silver crashed 11% in its worst single-day drop since 2020. Smaller traders were forced to liquidate. February 25th, 2026, silver breaks above 91. CME goes dark, 159 million ounces trade during the halt. March, open interest is cut in half. Silver drops $7, 3 critical moments, 3 convenient technical failures or margin hikes, 3 times the bank survived. You tell me if you believe in coincidences. While New York was going dark and silver was being slammed from 91 to 85, the rest of the world was still trading. And the rest of the world disagreed with the COMEX price. When Shanghai reopened after the CME halt, silver was pricing at $102 per ounce. Let that number sit with you. New York says silver is worth $85. Shanghai says it's worth $102. That's a $17 gap. That's a 20% premium for physical silver in China versus paper silver in New York. This is not a small discrepancy. This is not a rounding difference. This is 2 completely different markets telling 2 completely different stories. And there's a very simple explanation for why. The Shanghai Gold Exchange is a physical delivery market. When you buy silver on the SGE, you take delivery of actual silver bars. It's real metal in a real vault with your name on it. The SGE operates under the supervision of the People's Bank of China. It's designed to reflect actual supply and demand for physical silver. COMEX is a paper market. Less than 1% of contracts result in physical delivery. Most contracts are rolled, cash settled, or swapped through EFP deals. The price on COMEX reflects the supply and demand of paper contracts, not physical metal. And as we just saw, the paper market can be frozen, manipulated, and squeezed during a convenient technical outage. So when Shanghai prices silver at 102 and New York prices it at 85, the market is screaming a very clear message. The COMEX price is fake. The real price of physical silver, the price at which actual metal changes hands between willing buyers and sellers, is $17 higher. London is telling the same story. Silver lease rates, the cost to borrow physical silver for short-term delivery, spiked to 34.9%. Intraday peaks hit 39%. Normal lease rates are between 1 and 3%. This is a massive difference. When lease rates hit 39%, it means institutions are so desperate for borrowable physical silver that they'll pay almost 40% annualized interest. SLV implied volatility is sitting at 99 to 103% annualized, against a historical realized rate of 37%. The options market is pricing in the possibility of a massive move. The numbers scream stress, shortage, and dislocation. And yet, the paper price says $85. This is the great divorce. The paper price and the physical price are now living in 2 different realities. New York's reality is controlled by exchange halts, margin hikes, and EFP bribes. Shanghai's reality is controlled by industrial buyers who need silver for solar panels, electronics, and batteries. And they're paying whatever it costs. Which reality do you think will win? Today is Friday, February 27th, 2026. Today is COMEX March 1st Notice Day. This is the day sellers can announce their intent to deliver physical silver, and buyers must have full cash funded in their accounts. But the battlefield has been reshaped before the battle even started, thanks to Wednesday's halt and the subsequent 50% open interest reduction. The exchange is facing a much more manageable delivery month than what was originally projected. Instead of 109 million ounces of potential demand, they're looking at 52.6 million ounces. Against approximately 89 million ounces of registered inventory, that's a ratio of about 0.6 to 1. In theory, there's enough registered silver to cover it, barely. But here's what the banks didn't fix. Several structural problems remain, and they're getting worse, not better. Problem 1, the delivery rate pattern hasn't changed. February's delivery rate was 98%. January delivered 49.4 million ounces at over 7 times the 2024 level. Even if March only sees 50 to 60% of remaining open interest stand for delivery, that's still 26 to 31 million ounces of actual silver that needs to change hands. And remember, these aren't paper transfers. When someone stands for delivery in the current environment, they're demanding real metal. The February data proves that. Problem 2, every ounce that gets delivered in March is an ounce that's no longer in the vault for May, and May is the next major delivery month. The open interest for May silver is already building. If March drains another 20 to 30 million ounces from registered inventory, the May situation could be even more acute than March was supposed to be. Problem 3, the Shanghai premium. As long as physical silver in Shanghai commands a 20% premium over COMEX, there's an overwhelming financial incentive to pull silver from Western vaults and ship it east. Every day, the arbitrage opportunity drains metal from the system. Buy at 85 in New York, sell at 102 in Shanghai. You don't need to be a genius to see the trade. The longer this premium persists, the faster Western inventory depletes. Problem 4, industrial demand doesn't stop. Solar installations require silver, electric vehicles require silver, Samsung's solid-state battery program requires silver. These buyers don't care about COMEX open interest or CME trading halts. They need physical metal for manufacturing. They will pay whatever the Shanghai price demands, and they will continue to consume silver regardless of what the paper market does. Problem 5, confidence is eroding. Every time CME halts trading at a critical moment, every time margins are hiked during a holiday weekend, every time 159 million ounces move during an outage, the market's trust in COMEX as a fair price discovery mechanism deteriorates. And once trust is gone, participants stop using the exchange. They go direct to miners like Samsung did with Silverstorm Mining. They establish bilateral supply contracts. They bypass COMEX entirely. This is the end game. Not a single dramatic default on a single day, but a slow, grinding delegitimization of the paper pricing system. COMEX won't explode. It will become irrelevant. And when the physical market fully takes over price discovery, the price will be set by the place with the most demand and the least supply. That place is Shanghai, and Shanghai says $102. Let me give you the concrete signals I'm monitoring over the next 7 days. Today's first notice day data drops tomorrow, and the March delivery process unfolds over the next 30 days. Signal 1, today's standing delivery number. The first report publishes tomorrow, February 28th. It tells us how many of the remaining 10,126 contracts demanded physical silver. If over 5,000 contracts stand, that's 25 million ounces, we're in the stress zone. Over 7,035 million ounces is crisis territory despite the rug pull. Signal 2, SLV daily holdings. JP Morgan can raid SLVs on 91 million ounces to restock COMEX. Starting today, watch SLV's daily bar list on BlackRock's website. If total ounces drop by more than 3 million in a single day, the raid is happening. Over 10 million drop in the first week of March confirms large-scale extraction. Signal 3, registered inventory direction. COMEX registered silver is at 89 million ounces. If it drops below 80 million during March, we're approaching critical levels. But here's the tricky one. If registered inventory increases during a delivery month, that's the SLV raid in action. Metal from the ETF warranted for COMEX delivery shows as an increase. That's the smoking gun. Signal 4, Shanghai premium trajectory, currently around $17 or 20%. If it holds above 15% for the next 2 weeks, physical is firmly in control of pricing. If it narrows below 10%, it might mean Western supply is flowing east fast enough to partially close the gap, which means COMEX vaults are draining even faster. Signal 5, lease rates. London silver lease rates at 35 to 39% are screaming desperation. If they stay above 20% through the first week of March, the physical market is in full crisis, regardless of what the paper price shows. If they spike above 50%, we could see emergency measures from the LBMA itself. Now, let me be very direct about what all of this means for different types of silver investors. If you own SLV, I cannot stress this enough, your silver is the most likely source of metal for the March delivery process. JP Morgan is the custodian. JP Morgan is the authorized participant. JP Morgan has the legal mechanism to redeem your shares, extract the bars, and use them. I showed you exactly how this works in yesterday's video. If the March delivery demands exceed what's readily available in registered inventory, SLV is the piggy bank. If you own PSLV, you're in a much safer position. Sprott's silver is stored at the Royal Canadian Mint. No authorized participant can extract it without Sprott's direct consent. And Sprott just doubled their buying program to $2 billion. They're accumulating, not liquidating. If you own physical silver in your own possession, coins, bars, rounds, none of this affects your holdings. Your silver is yours. The only question is the price, and the physical market is telling you the real price is closer to 102 than 85. If you don't own silver yet, understand that the paper price and the physical price are now two different things. When you see $85 on your screen, that's the COMEX paper price. The actual cost to acquire physical silver, with premiums, delivery delays, and limited availability, is significantly higher. Here's the bottom line. Yesterday I told you JP Morgan had a plan. 24 hours later, that plan was executed in front of the entire world. They halted the exchange. They moved 159 million ounces in the dark. They crashed the price $7. They cut open interest in half. and they thought nobody would notice. They were wrong. I'll be covering the March delivery data daily. Subscribe and turn on notifications so you don't miss a single report. Tomorrow, we get the first standing delivery numbers. That data will tell us whether the rug pull was enough or whether the longs are coming back stronger. This is money and empires. They shut down the market. We turned on the lights.